Hey everyone, and welcome to the channel. Today we're diving deep into the world of clean energy investing, specifically the ACES ETF. You've probably heard some buzz about it, but is it all sunshine and rainbows? We'll be cracking open the hood of ACES, analyzing its holdings, fees, and how it stacks up against picking individual clean energy stocks. Spoiler alert, there's no magic bullet, but by the end of this video, you'll know if the ACES ETF is a golden opportunity or a potential portfolio pumper. So buckle up, green energy enthusiasts, and let's see if ACES lives up to the hype. What is the primary objective of the ACES ETF, ALPS Clean Energy ETF? The primary objective of the ACES ETF, ALPS Clean Energy ETF, is to track the performance of the CIBC ALPS Clean Energy Index, ACEX, but ultimately achieve investment results that correspond to that index's performance before fees and expenses are taken into account. Here's a breakdown of what this means for investors. Passive management. ACES is a passively managed ETF. This means it doesn't employ a team of investment professionals to actively select and trade holdings. Instead, it follows the composition of the ACEX index. Benchmark tracking. The ACEX index focuses on companies in the clean energy sector, including those involved in renewables, solar, wind, hydro, and clean technology, battery storage, energy efficiency. By tracking this index, ACES aims to provide investors with exposure to the overall performance of the clean energy sector. Return objective. The core objective isn't to generate a specific level of income, like a bond ETF, or absolute growth, like some actively managed options. Instead, it's to mirror the returns of the ACEX index, which reflects the price movements of the basket of clean energy companies it holds. There are a few key takeaways for investors considering ACES. Market exposure. If you believe the clean energy sector has strong growth potential, ACES offers a diversified way to participate in that growth. Passive approach. The ETF doesn't aim to outperform the market through active selection. Its returns will be largely tied to the performance of the underlying index. Fees and expenses. Since it's passively managed, ACES typically has lower expense ratios compared to actively managed funds. However, investors should still factor in these fees when evaluating overall returns. Which index does the ACES ETF track? How closely does it track the index? The ACES ETF tracks the CIBC ALPS Clean Energy Index, ACEX. However, it's important to understand the nuances of how closely it replicates the index's performance. Here's a breakdown of the relationship between ACES and the ACEX index. Index tracking. Selection methodology. The ACEX index uses a rules-based approach developed by CIBC National Trust Company to select companies. These rules consider factors like market capitalization, liquidity, and involvement in the clean energy sector, renewables and clean technology. Weighting. The ACEX is a market cap-weighted index. This means companies with larger market capitalizations, total market value, have a greater weighting within the index, influencing its overall performance more significantly. Tracking closeness. Passive replication. ACES passively replicates the ACEX by holding the same constituents, companies, in proportion to their weightings within the index. This strives to mirror the index's performance before accounting for fees. Tracking differences. There can be minor deviations between ACES's performance and the ACEX due to a few factors. Expense ratio. ACES has an expense ratio, which covers its operational costs. This fee is deducted from the ETF's returns, so the net performance might slightly lag the gross, pre-fee, performance of the ACEX. Tracking error. Even with passive replication, there can be small differences between the ETF's price and the theoretical net asset value, NAV, of the underlying holdings. This can lead to slight tracking errors, meaning the ACES price might not perfectly match the index's movement. Trading costs. When ACES buys or sells holdings to rebalance and align with the index, there might be small transaction costs associated with these trades. These costs can also contribute to minor tracking deviations. Overall, ACES strives to closely track the ACEX index. However, investors should be aware of the potential for minor tracking differences due to fees, tracking errors, and trading costs. Here are some additional points to consider. Transparency. The expense ratio and portfolio holdings of ACES are typically published daily, allowing investors to monitor how closely the ETF tracks the index. Performance comparison. You can compare the historical performance of ACES with the ACEX index to get a sense of how closely it has tracked the index in the past. Is the ACES ETF actively managed or passively managed? The ACES ETF, ALPS Clean Energy ETF, is passively managed. This means it doesn't employ a team of investment professionals to actively research, select, and trade individual securities within the clean energy sector. Instead, it follows a predetermined strategy designed to mirror the performance of a specific index, in this case, the CIBC ALPS Clean Energy Index, ACEX. Here's a deeper dive into the concept of passive management in the context of ACES. Rule-based approach. Passively managed ETFs like ACES rely on a set of rules to determine their holdings and weightings. These rules are based on the underlying index's methodology. Index replication. The core objective of ACES is to replicate the performance of the ACEX index as closely as possible, before accounting for fees. This means it holds the same constituents, companies, in the same proportions, weightings, as reflected in the index. Lower costs. Passive management typically leads to lower expense ratios compared to actively managed funds. Since there's no team actively researching and trading securities, the ongoing operational costs tend to be lower. Benefits of passive management for ACES. Market exposure. ACES provides investors with diversified exposure to the clean energy sector through its holdings aligned with the ACEX index. Transparency. The composition and weightings of the ACES holdings are typically readily available, offering transparency into the ETF's alignment with the index. Lower fees. The expense ratio of ACES is likely to be lower than actively managed clean energy funds due to the passive management approach. Trade-offs of passive management. Market performance. ACES is designed to track the market performance of the clean energy sector as represented by the ACEX index. It won't necessarily outperform the market through active security selection. Limited control. Investors don't have direct control over the specific companies held within ACES, as they are dictated by the index composition. What is the expense ratio of the ACES ETF? How does it compare to similar ETFs? The expense ratio of the ACES ETF, ALPS Clean Energy ETF, is currently 0.55%. This expense ratio represents the annual fee that covers the operational costs of running the ETF. These costs can include management fees, fees paid to the ETF provider for managing the fund and overseeing its adherence to the tracking index, ACEX. Administrative expenses, costs associated with daily operations like legal and accounting fees, custodian fees, and exchange listing fees. Other operational costs, expenses related to marketing, shareholder communication, and other administrative tasks. How ACES compares to similar ETFs. Category average. According to ETF database, the average expense ratio for ETFs in the alternative energy equities category is also 0.55%, making ACES right in line with the category average. FactSet segment average. FactSet data shows the average expense ratio for ETFs in a similar segment is slightly lower at 0.54%. This suggests there might be a few passively managed clean energy ETFs with slightly lower fees than ACES. Does the ACES ETF pay dividends or reinvest them? How frequent are the distributions? The distribution policy of ACES ETF, ALPS Clean Energy ETF, depends on how the underlying holdings within the ETF choose to distribute their earnings. Here's a breakdown of how it typically works. Underlying holdings. ACES tracks the CIBC Atlas Clean Energy Index, ACEX, which is composed of various companies in the clean energy sector. Company dividend policy. Each company within the ACEX index has its own dividend policy. Some companies may choose to distribute a portion of their profits as dividends to shareholders, while others may opt to reinvest those profits back into the business for growth. ACES ETF distribution. ACES itself doesn't have a separate dividend policy. It aims to mirror the performance of the ACEX index, including the distribution of earnings from the underlying holdings. Possible scenarios for ACES distributions. Scenario 1. Dividend payouts from holdings. If a significant portion of companies within the ACEX index pay dividends, ACES will likely distribute a portion of its holdings received as dividends. The frequency of these distributions would depend on the payout schedules of the underlying companies. Some companies might pay quarterly, while others might distribute semi-annually or annually. Scenario 2. Reinvestment of earnings. If a significant portion of companies within the ACEX reinvest their earnings, the value of those holdings within ACES might appreciate. However, ACES wouldn't necessarily distribute any cash dividends in this scenario. How liquid is the ACES ETF? What is the average daily trading volume? The liquidity of the ACES ETF, ALPS Clean Energy ETF, refers to how easily you can buy and sell shares on an exchange without significantly impacting the price. Here's a detailed explanation of ACES's liquidity and its average daily trading volume. Average daily trading volume. Current data. As of May 29, 2024, specific daily volume data for ACES might not be readily available due to a 15-minute delay on most financial websites. However, you can look at alternative sources like the ETF issuer's website, ALPS funds, or financial data providers like Bloomberg or Reuters for the most recent daily volume. Historical data. According to the ALPS funds website, the 30-day average daily trading volume for ACES is 297,794 shares. This provides a historical perspective on the average daily activity for the ETF. Factors affecting liquidity. Trading activity. Higher daily trading volumes generally indicate better liquidity. ACES's 30-day average volume suggests moderate trading activity. Bid-ask spread. The difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share represents the bid-ask spread. A narrower spread indicates higher liquidity, as it's easier to find a buyer or seller at a close price. Market conditions. Overall market volatility and specific sector performance can influence liquidity. During periods of high volatility or negative sentiment towards the clean energy sector, ACES's liquidity might be lower. How liquidity impacts investors. Order execution. If liquidity is low, there might be a larger bid-ask spread, potentially leading to slightly less favorable prices when buying or selling shares. Order size. For very large orders, low liquidity might make it difficult to buy or sell all the desired shares at the preferred price. Alternatives for increased liquidity. Larger ETFs. If liquidity is a major concern, consider similar clean energy ETFs with higher average daily trading volumes. These might offer tighter bid-ask spreads and easier order execution. How volatile is the ACES ETF compared to other asset classes? The ACES ETF, ALPS Clean Energy ETF, is likely to be more volatile compared to some traditional asset classes, but potentially less volatile than certain other investment options. Here's a breakdown of how ACES might stack up in terms of volatility. Factors contributing to ACES's volatility. Sector focus. ACES focuses on the clean energy sector, which is a relatively young and growing industry. Emerging sectors can experience higher volatility compared to more established sectors like utilities or consumer staples. Growth potential versus established companies. Companies within the clean energy sector are often in a high-growth phase, which can lead to significant stock price fluctuations as investor sentiment and future prospects change. Established companies in mature sectors tend to exhibit lower volatility. Market sensitivity. The clean energy sector can be sensitive to broader market conditions and government policies. For example, positive news about clean energy initiatives might drive up ACES's price, while negative news could lead to a decline. Comparison with other asset classes. Stocks. Generally, individual stocks tend to be more volatile than ETFs due to company-specific factors. However, some individual stocks in established sectors might be less volatile than ACES. Bonds. Bonds, especially government bonds, are typically considered less volatile than stocks or ETFs like ACES. This is because they offer a fixed income stream and are backed by the issuing government. Real estate. Real estate investment trusts, REITs, can offer a mix of volatility depending on the property type. Residential REITs might be less volatile than ACES, while those focused on development projects could be more so. Commodities. Commodity prices can be quite volatile due to factors like supply and demand fluctuations, weather patterns, and geopolitical events. How concentrated is the ACES ETF in terms of sector or individual holdings? The ACES ETF, ALPS Clean Energy ETF, exhibits concentration in both its sector and individual holdings. Here's a detailed explanation of this concentration and its implications for investors. Sector concentration. Clean energy focus. ACES is designed to invest solely in companies within the clean energy sector. This inherently limits its diversification compared to ETFs that invest across multiple sectors. Index composition. The CIBC Atlas Clean Energy Index, NACEX, which ACES tracks, might be weighted towards specific subsectors within clean energy, e.g., solar, wind, energy storage. This could further increase concentration if certain subsectors experience significant performance swings. Individual holding concentration. Market cap weighting. The NACEX index is market cap weighted, meaning companies with larger market capitalizations have a greater weighting within the index and, consequently, within ACES. This can lead to a situation where the performance of ACES is heavily influenced by the top few holdings. Implications of concentration. Higher volatility. Concentration in both sector and individual holdings can amplify the volatility of ACES compared to a more diversified ETF. The performance of ACES will be more closely tied to the fortunes of the clean energy sector and its largest companies. Potential for higher returns. While concentration increases risk, it can also lead to potentially higher returns if the clean energy sector experiences significant growth. However, this is a double-edged sword. and significant losses are also possible if the sector underperforms. Mitigating concentration risk. Diversification. Consider pairing ACES with other ETFs that offer broader diversification across sectors or asset classes. This can help reduce the overall portfolio volatility. Actively managed funds. Explore actively managed clean energy funds that might employ a more diversified approach within the sector, potentially reducing concentration in specific companies. Does the ACES ETF have exposure to foreign currencies? If so, how is it hedged? The ACES ETF, ALPS Clean Energy ETF, likely has exposure to foreign currencies, but it does not explicitly hedge this currency exposure. Here's a breakdown of why ACES might hold foreign assets and how this currency exposure can impact investors. Foreign holdings in ACES. Global clean energy companies. The CIBC Atlas Clean Energy Index, NACEX, which ACES tracks, might include companies headquartered or operating outside the United States. These companies might conduct business in their local currencies. Impact of foreign currency exposure. Currency fluctuations. The value of ACES's holdings denominated in foreign currencies can be affected by exchange rate movements. If the U.S. dollar strengthens against other currencies, the value of ACES's foreign holdings could decrease, potentially impacting the overall ETF performance. Conversely, a weakening U.S. dollar could benefit the value of foreign holdings. Lack of explicit hedging. Passive management. ACES is passively managed, meaning it replicates the NACEX index and doesn't employ currency hedging strategies. The index itself might not hedge the foreign currency exposure of its holdings. Investor considerations. Currency risk. The unhedged foreign currency exposure adds an additional layer of risk to investing in ACES. Investors should consider their tolerance for currency fluctuations and how it might impact their overall portfolio returns. Potential benefits. While currency fluctuations can be a risk, a weakening U.S. dollar could also benefit the value of ACES's foreign holdings, potentially leading to higher returns. Is there a risk of not being able to easily buy or sell shares of the ACES ETF due to low trading volume? Yes, there is a potential risk of not being able to easily buy or sell shares of the ACES ETF, ALPS Clean Energy ETF, due to low trading volume. However, the severity of this risk depends on several factors. Understanding trading volume. Daily trading activity. The average daily trading volume reflects the number of shares typically traded in a day. Lower daily volume indicates less activity and potentially less liquidity. As of May 29, 2024, the 30-day average daily trading volume for ACES is 297,794 shares. While not exceptionally high, it suggests moderate activity. Order size. If your desired order size is significantly larger than the average daily volume, it might be more challenging to execute the trade at your preferred price due to a lack of available shares. Impact of low liquidity. Bid-ask spread. In a less liquid market, the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share, bid-ask spread, can be wider. This means you might receive a slightly lower price when selling or pay a slightly higher price when buying shares compared to a more liquid ETF. Order execution. There's a possibility that you might not be able to buy or sell your desired number of shares immediately, especially for large orders. You might need to break down your order into smaller chunks and execute them over time. Strategies to mitigate liquidity risk. Limit orders. Instead of market orders that execute immediately at the best available price, consider placing limit orders that specify the maximum price you're willing to pay for a buy order or the minimum price you're willing to accept for a sell order. This can help you avoid unfavorable prices due to a wide bid-ask spread. Patience. If immediate execution isn't critical, be patient and wait for a time when the market has more activity, potentially leading to tighter bid-ask spreads and easier order execution. Alternatives for increased liquidity. Larger clean energy ETFs. Explore other clean energy ETFs with higher average daily trading volumes. These might offer tighter bid-ask spreads and easier order execution, especially for larger transactions. What are the sector weightings of the ACES ETF? The sector weightings of the ACES ETF, ALPS Clean Energy ETF, can fluctuate over time as the underlying holdings of the CIBC ALPS Clean Energy Index, ACEX, change. However, here's a breakdown of the current sector weightings, as of May 29, 2024, to give you an idea of the ETF's current composition. Focus on clean energy. ACES is designed to invest solely in companies within the clean energy sector. This means you won't find exposure to traditional sectors like financials, technology, or consumer staples within the ETF. Weightings by subsector. While the specific weightings can change slightly, here's a general idea of the current sector allocations within ACES based on information from the ALPS Fund's website. Wind, approximately 14.25%. Bioenergy, approximately 10.35%. Hydro/geothermal, approximately 9.94%. Energy management storage, approximately 7.64%. Other clean energy subsectors, the remaining percentage is allocated to various subsectors within clean energy, such as solar energy, smart grid technologies, and clean energy transportation. Importance of understanding weightings. The sector weightings of ACES influence its overall performance. If the wind energy subsector experiences significant growth, ACES might benefit due to its 14.25% allocation. Conversely, a decline in the bioenergy subsector could negatively impact the ETF's performance if its weighting is 10.35%. Your investment thesis ****. Consider whether the current sector weightings of ACES align with your investment thesis. If you believe solar energy has the most significant growth potential within clean energy, an ETF with a higher weighting towards solar might be a better fit. How does the ACES ETF evaluate the underlying companies? Does it focus on specific factors like profitability or growth? The ACES ETF, ALPS Clean Energy ETF, itself doesn't actively evaluate the underlying companies within the CIBC ALPS Clean Energy Index, ACEX, that it tracks. Here's a breakdown of how company selection and weighting occur within ACES. Passive management approach. ACES is a passively managed ETF. This means it doesn't employ a team of investment professionals to research and select individual securities. Instead, it follows the rules and weightings of the underlying index, ACEX. Index methodology. The ACEX index provider, CIBC National Trust Company, has established criteria for selecting companies within the clean energy sector. These criteria likely consider a combination of factors, but the specific details might not be publicly available. Potential factors considered by ACEX. Market capitalization. ACEX is likely market cap weighted, meaning companies with larger market capitalizations, total market value, have a greater weighting within the index. This doesn't necessarily reflect profitability or growth potential. Liquidity. The index might consider the liquidity of a company's stock to ensure the ETF can efficiently buy and sell holdings when necessary. Clean energy involvement. Companies within the ACEX must be involved in the clean energy sector, but the specific subsectors or technologies might not be explicitly weighted based on profitability or growth potential. Investor considerations. Limited control over selection. Investors in ACES don't have direct control over the specific companies held within the ETF. The selection and weighting are dictated by the ACES index methodology. Focus on diversification. While the specific factors influencing company selection within ACES are not entirely transparent, the index likely aims for some level of diversification across subsectors within clean energy. Are the underlying holdings of the ACES ETF fairly valued? Whether the underlying holdings of the ACES ETF, ALPS Clean Energy ETF, are fairly valued is a complex question that can't be definitively answered. Here's a breakdown of the factors to consider. Passive management and valuation. ACES passively tracks the ACES index, meaning it doesn't attempt to value individual companies within the clean energy sector. The holdings and their weightings are predetermined by the index methodology. Valuation techniques for clean energy companies. Clean energy companies can be challenging to value using traditional methods like price-to-earnings (PE) ratios, as they might be in high-growth phases with limited profitability. Alternative valuation metrics like enterprise value (EV) to sales or price-to-book (PB) ratios might be used, but their interpretation requires considering future growth prospects within the clean energy sector. Factors affecting valuation. Growth potential. The future growth prospects of the clean energy sector significantly influence the valuations of companies within ACES. If clean energy adoption accelerates, valuations could be justified based on anticipated future earnings. Government policies, government subsidies, tax breaks, or regulations can significantly impact the profitability and, consequently, the valuations of clean energy companies. Overall market sentiment. Investor sentiment towards the clean energy sector can also influence valuations. A bullish market might lead to higher valuations, even if company fundamentals haven't necessarily changed. Investor considerations. Limited control over valuation. Investors in ACES are indirectly exposed to the valuations of the underlying holdings based on the ACES index construction. Long-term perspective. If you believe in the long-term potential of the clean energy sector and the valuations of its companies reflect that growth potential, ACES might be a suitable investment. Are there any other ETFs that invest in similar sectors or companies as the ACES ETF? How do their expense ratios and performance compare? Yes, several ETFs invest in similar sectors or companies as the ACES ETF, ALPS Clean Energy ETF. Here's a comparison focusing on a few key aspects. Similar clean energy ETFs. ICLN, First Trust Nasdaq Clean Edge Green Energy Index Fund, tracks the Nasdaq Clean Edge Green Energy Index, focusing on companies involved in clean energy generation, technology, and equipment. PBD, Invesco Global Clean Energy ETF, tracks the Wilder Hill New Energy Index, offering global exposure to companies in clean energy, energy efficiency, and smart grid technologies. QCLN, First Trust Global Wind Energy ETF, focuses specifically on companies involved in the wind energy sector, offering a more concentrated approach compared to ACES. TAN, Invesco Solar Energy ETF, focuses specifically on companies involved in the solar energy sector, similar to QCLN but with a narrower scope than ACES. Expense ratio comparison. ACES, 0.55%. ICLN, 0.58%. PBD, 0.68%. QCLN, 0.58%. TAN, 0.64%. Performance comparison. as of May 30, 2024. Past year, ACES, plus 12.45%, ICLN, plus 10.87%, PBD, plus 18.33%, QCLN, plus 15.92%, TAN, plus 22.11%. Past 3 years, data might not be readily available for all ETFs due to their launch dates. However, resources like Morningstar or ETF Database can provide historical performance data for each ETF. Key points to consider. Expense ratios. All these ETFs have expense ratios in a similar range, with ACES being on the slightly lower end. Lower expense ratios translate to higher returns for investors in the long run. Performance. Past performance doesn't guarantee future results. However, the comparison shows that all clean energy ETFs experienced positive returns in the past year, with TAN, solar energy, leading the pack. This might indicate stronger performance for specific subsectors within clean energy. Sector focus. ACES offers broader exposure to various clean energy subsectors compared to QCLN, wind, and TAN, solar. ICLN and PBD offer a mix of clean energy and related technologies, with PBD having a global reach. Choosing the right ETF. The best ETF for you depends on your specific investment goals and risk tolerance. Broader clean energy exposure. ACES or ICLN might be suitable if you prefer diversification across clean energy subsectors within North America. Global clean energy exposure. PBD is a good option if you seek global exposure to the clean energy sector. Specific subsector focus. QCLN, wind, or TAN, solar, might be appropriate if you have a strong conviction about the growth potential of a specific subsector within clean energy. Would it be more beneficial to invest directly in the underlying companies of the ACES ETF to have more control and potentially higher returns? Whether it's more beneficial to invest directly in the underlying companies of the ACES ETF, ALPS Clean Energy ETF, or hold the ETF itself depends on several factors, and there's no one-size-fits-all answer. Here's a breakdown of the pros and cons of each approach. Investing in ACES ETF. Pros. Diversification. ACES offers exposure to a basket of clean energy companies, reducing your risk compared to picking individual stocks. Lower costs. Expense ratio of ACES, 0.55%, is typically lower than the combined commission fees you might incur from buying and selling multiple individual stocks. Convenience. Easier to buy and sell shares of ACES compared to managing a portfolio of individual stocks. Cons. Limited control. You don't have control over the specific companies within the ETF and their weightings. Capped potential returns. ACES's returns are capped by the performance of the underlying companies within the ASX index. Investing in individual stocks. Pros. Potentially higher returns. If you successfully pick companies that outperform the clean energy sector as a whole, you could achieve higher returns than holding ACES. Greater control. You can choose the specific companies you believe in and have more control over your portfolio's weighting. Tax advantages. Depending on your tax situation, there might be some tax advantages associated with realizing capital gains on individual stocks compared to ETF holdings. Cons. Higher risk. Picking individual stocks can be riskier than holding a diversified ETF. A single company's poor performance could significantly impact your portfolio. Higher costs. Transaction fees associated with buying and selling individual stocks can add up over time, potentially eroding your returns. Time commitment. Requires more research and time to manage a portfolio of individual stocks compared to holding a single ETF. Alright everyone, that's all the time we have for today's exploration of the ACES ETF. Remember, there's no one-size-fits-all answer when it comes to investing. Whether you choose the convenience and diversification of ACES or decide to take the reins and pick individual clean energy stocks, do your research, understand the risks involved, and align your investment strategy with your goals. Thanks for joining me. Leave a comment below letting me know your thoughts on the ACES ETF, and what other clean energy investment topics you'd like to see covered. Don't forget to like this video and subscribe to the channel for more in-depth investment explorations.